We want to bring in another voice here who's just watching Fed Chair Jerome Powell's press conference after the Fed raised rates once again by 25 basis points. We want to bring in Brent Schutte, Northwestern Mutual Wealth Management Chief Investment Officer. Brent, it's good to see you. So we were just talking about the lack thereof of the reaction that we're seeing in the market right now. It seems like investors are pretty split on what the Fed is going to do from here. What did you make? What is your assessment of what we just heard from Powell?
Yeah, I think you nailed it pretty good in your opening comments there, talking about how he kind of walked that fine line and really talked about being more patient and having done quite a bit already. I think the big thing here, and this is where you made some comments on wages, and he kind of shunned it off just a bit. But this, to me, is the most important thing that's out there. This is the last frontier of inflation. So all you talked about, the CPI stuff, that is coming down because it was tied to COVID. That's where we were optimistic because we believed that would come down because it was tied to COVID and we're moving further past that. And it has. Unfortunately, the Fed worries about wage inflation, and wage inflation has not come down because the labor market is still tight. And so to me, the Fed doesn't want to repeat 66 to 82, where wages rose pretty much from 3.7% all the way to 9.4% by early 1981. They were pretty much up, and they pulled that CPI back higher. To me, Jerome said it best, Chair Powell said it best when he said, we want to get wages down to what is consistent with 2% inflation. That number, my answer is, or has been, at least in the past, according to the Fed, around 4%. We are at 4.7% year over year on wages for non-supervisory and production workers. And the last three cycles peaked out around 4 to 4.4%, which is what the Fed targets. And we're still above that. And so that's why I think they'll have to keep going until they see the labor market break, which to me is exactly what he says is not going to happen. We call that a recession. And so I don't think they're going to get out of this without causing a recession unless magically a bunch of people come back to provide labor.
So Brent, let's talk about that level that you think wages should be at. The next question is how much of that has to do with the Fed? How much of that policy is already taking shape? How much of this is about just waiting for it to take shape even further? The hawkish camp, of course, would say you've got to hike rates yet again.
Yeah, perhaps. I mean, this is where he doesn't know, nor does anybody else really. I mean, when does the job market really start softening? I'm surprised how resilient it has been. I thought it would have softened by now, just given the cumulative impact of rate hikes. And you actually have seen some softening. But certainly wages are the price mechanism the Fed looks at. And as I mentioned before, wages right now pretty consistently on a 3-month, 6-month, 9-month, 1-year basis are at 4.5 to 4.7%, which is above kind of that non-inflationary ceiling the Fed put on the prior 3 cycles, and that was around 4%. And so how do you get that to come down? You get that to come down typically every one of those time periods ended with a recession. And so I don't think the Fed is magically going to land this one right where there's no job losses and wages come down. I think there's going to be job losses, and that's why I think there's going to be a recession.
So, Brent, this might be a little bit hard to predict, but when you talk about the fact that the labor market could break, we need to see, or we likely will see, job losses in order to get wages down. What's the extent of those job losses, and what does that mean in terms of how deep of a recession we could potentially be in at that point?
Yeah, this is where I think it can be mild. I mean, look, the Fed policy right now is at 5.25 to 5.50. If the neutral rate is 2.5 and inflation goes by the wayside, so I think current CPI is going by the wayside, I think wages could pull it back up. But if wages fall, current CPI is low, I think the Fed can cut if they need to, probably fairly aggressively. And I do think monetary policy has a more immediate impact in today's world. So I do agree with those comments from some other Fed governors. And so that's where I think they can keep it mild if they have to, because I think inflation is going to be completely eradicated from the U.S. economy if we do have that recession, and that will keep it more mild.
So, Brent, ultimately, what does that suggest in terms of the trajectory of the Fed's policy going into year end? Will we see another rate hike, or is another rate hike necessary?
That's where I don't think the Fed knows. They're data dependent, nor do I think anybody on Wall Street knows. I mean, to me, we're at or near the end. You've seen jobless claims. I know they're still low. They've ticked up. I think everybody thinks that before a recession, the unemployment rate spikes, jobless claims spikes, but that's not the case. And so you've already seen moves in jobless claims and continuing claims that have been consistent with recession starts of the past. And so I think we're knocking on the door. We're certainly not there yet. I think it's likely that the Fed is near to the end, but I do think there's probably still at least one more hike before the job market breaks. But that certainly is not a perfect analysis. And I just think, I think to me, investors should focus more on this is what end of cycles look like. And that's where if we don't have a recession in the next few months, the next few quarters, I don't think you're years away from one, because we are out of workers to provide labor. And that typically is the end of every economic cycle. And so is it 3 months from now? Is it 6 months from now? Is it a year from now? I think it's well within each and every one of those time periods that you're likely to have one.
So, Brent, what does this mean for investment portfolios? How defensive should investors be given the fact that there's so much uncertainty still?
Yeah, I mean, this is where I think there's good news. I think most people who listen to your show own fixed income. And to me, fixed income has completely repriced to now yielding somewhere around 5%, where it yielded 1.75% before the Fed started hiking rates. And that was when inflation was running at 7%. Now you're near 5% on investment grade bonds, and inflation is faltering. And so I think, once again, bonds are a hedge against equity market downside and offer real value as inflation falls. And so certainly that's an area we've become more defensive. I think the other good news is that if it's a mild recession, I don't think the market has to make dramatic new lows or even make new lows. And I think there are cheap parts of the market that should do fairly well in a mild recession, called small and mid caps, which trade at 14 to 15 times earnings. They typically don't do well in a recession. But again, they've discounted some of that. They're cheap. And I think investors can own those through the recession. And the opposite side of that can be very strong for them.
All right, Brent Schutte, always great to get your perspective there. Northwestern Mutual Wealth Management Chief Investment Officer. Thanks.